When manufacturing firms use the normal costing system, they are putting all of those indirect, untraceable overhead costs into jobs during the period based upon an estimate. And they know their business very well. That estimate might be a very, very good estimate, but it's probably not going to be a perfect estimate. It's just too impossible to know exactly what amount of indirect cost your manufacturing firm is going to incur during the period. And it's also impossible to know what exact amount of the component of production you've chosen to use as your cost driver is also going to be incurred during the period. What I'm getting at is at the end of the period, even though you did your best, your costs are going to be off. You're going to have indirect costs put into jobs that aren't equal to exactly what they should have been, and you need to fix this. How will you fix it? Well, there's three different approaches. The first approach is the adjusted allocation rate approach. And in this, once you know all of your actual overhead costs for the period and you know your actual quantity of the cost driver for the period, you go back and you look at all of those journal entries that you recorded under your normal costing system using estimates. And you know all of those are bad. So you reverse out every single one of those entries. If you had a debit to finished goods inventory and a credit to WIP inventory for a certain amount, how do you reverse it out? You just flip that entry upside down. And when you do so, it negates the effects that the entry had on your books. And then after you've done that, you re-record all of those entries using the actual amount of allocation rate you should be using, which would be your actual indirect cost divided by your actual quantity of the driver. This method is the perfect method for having your numbers be exactly correct. You're going to end up with just precisely the right amount of overhead in each job based upon what you chose as your driver. The problem with it is it requires all of your accountants to go back in, reverse out a bunch of stuff, do more calculations, and then re-enter them. And accountants, they don't, for you guys, thankfully, they don't come cheap, which means you're paying a lot of money to have this accuracy on your books. And for some companies, that accuracy that you have isn't worth the cost of having to pay your accountants hundreds, if not thousands of dollars of extra money to fix their books using the adjusted allocation rate approach. So this approach is unquestionably the best way to get accurate books, but it's also the most costly way. And sometimes costs that are, don't warrant the benefits that you get from them. If you can do entries using the normal costing system, you can do entries using the adjusted allocation rate approach. It's the same exact thing. Just take the bad entries off your books, use the same steps you used for normal costing, and re-record better entries knowing exactly what happened. And because of that, I'm not going to go through and make you do a whole example of the adjusted allocation rate approach. Like I said, if you know how to do it, you can do this. It's just incredibly time consuming for very little benefit. But I do want you to know the other two. And the first one is the proration approach. And where do these costs end up at the end of the period? I mean, we're moving costs through our various inventory accounts, and eventually once some of those jobs that we're recording under job order costing get sold, it ends up in COGS. So all of these indirect costs have to be contained in one of three accounts at the end of the period: WIP, finished goods, or COGS. The proration approach is going to spread out the amount of under or over allocation you have to these three different accounts based upon what percentage of your total indirect costs, according to your normal costing system, ended up in those accounts at the end of the period. It's a much quicker and easier way to fix your issues with your indirect costs, and it allows you to, put some of that missed cost into your inventory accounts. If you wish, the easiest and fastest way to do this is just to write off everything to COGS. I mean, eventually all of your inventory is going to end up getting sold anyway. It's going to end up in COGS at some point. So if you have an under or over allocation at the end of the period, just adjust your cost of goods sold account by how much you missed by. Let's do an example using the proration approach. So we have Wilson Brothers, who during the period allocated $80,000 of overhead out of their pool to their various jobs. When they got their actual indirect costs for the period, they realized that they were $94,000. They have a pretty severe under allocation. At the end of the period, we can figure out not only what the balance of these three accounts being affected are, our WIP inventory, our finished goods inventory, and our COGS, but by referencing those job cost records, we can figure out the total amount of overhead that we've allocated to jobs which are still in process, the total amount of overhead which we've allocated already to jobs which are finished but not yet sold, and the total amount of overhead we allocated to jobs which we have finished and sold and ended up in COGS. So at period's end for Wilson Brothers, their inventory WIP inventory has a balance of $62,000. Their finished goods inventory has a balance of $90,000, and they've recorded cost of goods sold of $488,000. In total, $640,000 of production costs have ended up spread out amongst these three different accounts. And referencing the job cost records, they figured out that $8,000 of that $62,000 that went into WIP was from manufacturing overhead being allocated. $14,000 of that $90,000 that's in finished goods is from manufacturing overhead, which was allocated out of the pool, and $58,000 of the $488,000 in COGS was from manufacturing overhead, which was allocated out of the pool into jobs which they eventually sold. And that's how they spread out the $80,000 worth of overhead that they've allocated. Well, what percent of the overhead which was allocated ended up in each of these different accounts? You can figure that out by just taking the amount of manufacturing overhead which is allocated to that account, again by summing up the amount of overhead on each one of your job cost records for jobs that are still a work in process at period's end. Take that amount which has been allocated already and divide it by the total amount of overhead you allocated during the period. If $8,000 of overhead was allocated to jobs which are still in WIP out of the $80,000 in total, that means 10% of the overhead which we allocated during the period ended up in WIP. For finished goods, $14,000 of overhead has been allocated to jobs which we have finished but not yet sold. Out of the $80,000 worth of overhead we allocated in total across all jobs, that means that 17.5% of the overhead that we allocated ended up in jobs which are considered at this point to be finished goods inventory. And the remaining $58,000 of overhead which was allocated during the period was allocated to jobs which we finished and sold, and their cost ended up being expensed under COGS. $58,000 is 72.5% of the $80,000 which we've allocated. If we add up those percentages, they add up and they should always to 100%. So we've accounted for all 100% of that $80,000 of overhead which was allocated out of the pool to various jobs. Well, we know how much we missed by. Again, we allocated $80,000 during the period, and we know that we were $14,000 too light. We underallocated by $14,000. We should have an extra $14,000 in all of our accounts for the stuff that we did in production, and it's not there. So we need to spread that $14,000 out. How are we going to spread it out? Well, if we prorate, we take a percentage of that amount we missed by, $14,000, and put an extra, in this case because it's an under allocation, amount of overhead into that job equal to the proportion of the overhead that we did allocate which ended up in that account. If 10% of our overhead ended up in jobs which are still considered WIP, why don't we take 10% of that misallocation right here and also put it into WIP inventory? So the amount of over or under allocation we had times the percentage of total manufacturing overhead which is allocated to that account. And 10% of 14,000 is 1,400. 17.5% of 14,000 is 2,450, and 72.5% of 14,000 is 10,150. If we add these three numbers up, they should equal the total of our misallocation, and they do. It adds up to 14,000. So what we're saying here is, based upon how much of the overhead we did allocate ended up in these different jobs, we should be allocating the following amounts to those jobs to keep costs proportionate. What will the new balance of these accounts be? The key word here is under allocation. There's not enough cost in these jobs. So since there's not enough cost, that amount that we're prorating has to be added. If we had an over allocation, that would mean there was too much cost in the job. So the amount that we prorate would have to be subtracted. But here, since we have an under allocation, we're going to find our new balances by simply taking what it was before and adding to it the extra amount that we have to put in. 62,000 plus 1,400 is 63,400. 90,000 plus 2,450 is 92,450, and for COGS, 488,000 plus 10,150 is going to make the new balance of our cost of goods sold, 498,150. We add up those three numbers together, we come up with $654,000, which is conveniently what the balance was, plus the extra amount we had to prorate in because we under allocated. So now that we figured out how much cost has to be added to each of these accounts, we can just record it in a journal entry to increase the balance of those inventory and COGS accounts and close out our manufacturing overhead pool for the period. And the journal entry looks a little something like this. We are increasing the value of WIP and finished goods inventory. Since they're both assets, they increase on the debit side. So we're going to debit WIP inventory for the amount we prorated, 1,400. We're going to debit finished goods inventory for the amount we prorated, $2,450. Cost of goods sold is an expense, also goes up on the debit side, and we increase the amount of cost of goods sold we're going to recognize during the period by $10,150. So we debit cost of goods sold for $10,150. And our credit is to our manufacturing overhead pool. Since we underallocated, we have to allocate an additional $14,000 out of the pool to the different jobs that we have. Well, in the manufacturing overhead transitional account, when you allocate out on the credit side. So that's why we have a credit to manufacturing overhead for 14 grand. And now, after we've done this adjusting entry to fix our misallocation, our manufacturing overhead T is going to have on the debit side the $4,000 of direct materials, the $15,000 of direct labor, and the $75,000 of other inventoriable overhead costs. On the credit side, we're going to have the $80,000 that we allocated out during the period based on our best guess, and the extra $14,000 that we allocated out at the end of the period once we realized our guess was too light. That's $94,000 of debits, $94,000 of credits, giving us a balance of 0. And manufacturing overhead, because it is a temporary account, should always have a balance of 0 at the end of the period once you know what all of your actual costs were. So that's a little bit of work, but it's way faster than going back and having to reverse out all your entries and do some more calculations and re-record all those entries under a normal costing system using the actual amounts that you had. But what's even less work than the proration approach is the write-off to COGS approach. We missed by 14,000. We're going to operate under the theory that no matter what state of completion our inventory is in, at some point it's going to get finished and it's going to get sold, which means all of these costs that we missed by at some point in time are going to end up in our cost of goods sold account. Well, let's just do this now. And that is this simple journal entry. If you use the write-off to COGS method, all you do is you debit COGS for the, in the case of an underallocation, you debit COGS for $14,000, the amount that you missed by. You credit manufacturing overhead for that same amount. It's going to close out your manufacturing overhead pool. The difference between these two different methodologies is that here we're lowering our expense a little bit. We're not putting the full $14,000 in there. We're preserving some of that underallocation in our asset accounts, increasing the value of our assets. Here, the whole enchilada, if you will, ends up in cost of goods sold, which means you're going to have less income, you're going to have lower value of your assets, etc. So which method do you use depends on what your company's trying to do when they fix their underallocation. If you're flipping goods really fast, you finish a job and it sells almost instantly and you're not carrying a bunch of inventory on your books, this might be the superior method. Gives, by the time people use your information, it's going to give a more accurate representation. Most of those jobs that you underallocated to will be sold by that point. If you're Wilson Brothers in this case, though, who build homes and fancy sheds and Lord knows what else, they probably carry a significant amount of inventory on their books at all time. And I think this is probably a better way to get a more accurate portrayal of their financial position.